Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning and welcome to today's webcast, Not-for-Profit Accounting and Auditing, Fall 2016 Update. I'm happy to introduce today's speakers, Tammy Erickson and Danielle O'Connor. Tammy has been in public accounting since 1993 and leads the Washington Region's government and not-for-profit practice. She provides accounting, auditing, and consulting services to higher education, quasi-governmental, healthcare, and other not-for-profit organizations. Specifically, she coordinates and supervises audits, consults on internal controls, and provides continuing education classes for various organizations. Tammy also specializes in performance audits with federal agencies. Danielle has been in public accounting since 2004 and serves a variety of not-for-profits, including universities, religious organizations, foundations, and social service organizations. She has experience conducting audits in accordance with government auditing standards and the Single Audit Act. She provides training on accounting and auditing topics for Moss Adams professionals as well as clients and industry organizations. Tammy, I will turn the line over to you to get us started.
Great, thank you very much. Well, good morning, everyone. Welcome to our webcast this morning. We're going to be talking about some fun and exciting topics here. Primarily, we are going to talk very briefly about some of the recently issued standards that have come out and that have an impact on some not-for-profit organizations. More specifically, we are going to spend the majority of the time today talking about FASB's new standard that was just recently issued that impacts our not-for-profit organizations. And then again, very briefly, we will talk about some of the other projects that are on the horizon for FASB that may end up impacting you in the future. So hopefully you will find this helpful as you start to prepare for some of these new standards that are coming. We do have, as you know, a couple of polling questions here. This is part of ensuring that you do get CPE and also gives us a little bit of information here with our first question, which is what type of not-for-profit organization do you represent? We have a variety of institutions here, types of institutions. If you wouldn't mind marking which one you belong to. We do have an other category there in case we have not captured the type of institution that you're with. I'll give it a second here for everybody to mark their answers so we can ensure that people are getting their credit. Okay, go ahead and see what we have here. So it looks like we have quite a few foundations or grant-making type entities. We have some healthcare entities, a pretty equivalent amount, quite a bit of higher education entities here on the call, some social services, a few research institutions, some trade associations, and then, of course, several that fit in the other category. I think this is helpful for us as we go through our presentation here and try to ensure that we're hitting on some of the key aspects that impact the majority of our listeners. We have one other, whoops, sorry, nope, we don't have another polling question. That comes up later. Okay, we are going to talk again briefly about some of the recently issued standards. There have been quite a few that do impact not-for-profit organizations. A lot of these standards are really to help reduce both the cost and complexity of implementing and following the standards that are currently in place. One of those has to do with the imputation of interest, and this is really specific to debt issuance costs. In the past, those debt issuance costs have been shown as an asset and amortized over the life of that debt issuance, and under the new standard, those debt issuance costs will be shown as a deduction from the carrying amount of that debt. So very consistent with what we see with discounts related to the debt. This is effective for fiscal years beginning after December 15, 2015. So in other words, it will be effective for December 31st, 2016 year ends or June 30th, 2017 year ends. You can early adopt this. This is more of a classification of those debt issuance costs within the statements. The not-for-profit presentation of financial statements, again, that is what we are going to spend the majority of this morning talking about, so that will be coming up here. There have been some standards related to intangibles, goodwills, and some of the other topics, business combinations, some consolidation, derivatives, and hedging topics. So quite a bit there. Some of the hedging has more to do with electric companies, purchases and sales of contracts there. Some of the intangibles have to do with cloud computing arrangements. So if you have any cloud computing arrangements, that would likely impact you, something to look at there. There's also been some statements here related to derivatives and hedging, investments with equity method joint ventures, revenue from contracts with customers. This was put into place a couple of years ago. Well, it wasn't actually, it was going to be effective for years beginning after 2016. That has been deferred for years beginning after 2017 for certain organizations and after 2018 for others, depending upon whether you are a public entity or some nonprofits with conduit bonds end up having that earlier implementation date. A standard that will have a pretty significant impact, of course, has to do with leases. And this is really to increase the transparency and comparability among organizations with leases. Really, the main difference there is recognizing leases that historically have been accounted for as an operating lease, that they now will be shown as an asset and a related liability within the balance sheet. And it's really recording a right to use right of use of that asset and then the related liabilities. So again, really providing more transparency over those leases. And that is effective for fiscal years beginning after December 15th, 2018 for public entities, and again, nonprofits with conduit bonds, or years ending after years beginning after December 15th, 2019 for other organizations. There was also some additional clarification with the statement of cash flows for certain cash receipts and payments and how those should be presented. So a lot going on with nonprofits, but again, we are going to focus on the new not-for-profit standard. So in August of this year, the FASB did issue a standard that was really intended to simplify and improve how a not-for-profit organization classifies its net assets, as well as the information it presents in the financial statements and notes about its liquidity, financial performance, and cash flows. As you know, the current not-for-profit financial reporting model has held up pretty well for over 20 years since the issuance of the Statement of Financial Accounting Standards 117, which was the financial statements of not-for-profit organizations. And that was a big change for a lot of nonprofits when that standard came out back in 1993. However, there's been a lot of concerns about the complexity in the use of the three classifications of the net assets, so your unrestricted net assets, temporarily restricted, and permanently restricted net assets, as well as deficiencies in the transparency and the utility of the information in assessing an organization's liquidity. There were inconsistencies in the type of information provided about expenses, as well as misunderstandings about the limited usefulness of the statement of cash flows, particularly with regards to the reporting of operating cash flows. So based upon these concerns, the FASB's Not-for-Profit Advisory Committee and other stakeholders had suggested that an update would be beneficial. They spent a couple of years looking at this. There was an exposure draft that came out related to this, and what they've ended up doing is really breaking this out into two parts. So we have this current portion that was issued back in August that really hit on the areas where there was consensus, and then they have a phase two that we'll talk about a little bit later, which are some areas that they are continuing their discussions and ensuring that what they end up doing makes sense for not-for-profit organizations. So the effective dates for this is for fiscal years beginning after December 15th, 2017. So in other words, that would be for fiscal years ending December 31st, 2018, or June 30th, 2019 for those who have either a December year-end or a June year-end. You can early adopt this statement. There are some provisions in this statement that I think a lot of you will like to see, and so early adoption is permitted. If you do early adopt, you do need to make sure that you're applying all the provisions of the standard in the year of adoption. However, if you have comparative financial statements in the year of adoption, you do not have to show your expenses by natural and functional analysis or the disclosures on liquidity and the availability of those resources. Danielle, you want to talk about the net asset classes?
Sure. Thank you, Tammy. Good morning, everyone. So the first change we're going to discuss is the net asset classification. These changes are expected to enhance the readers of the financial statements' understanding of the donor restrictions. So the objectives of the change in the net asset classification are really to address any misconceptions about what is considered unrestricted and the availability of these funds. The FASB believes that some financial statement users have in the past interpreted the term unrestricted to mean the absence of any restrictions, so things like legal or contractual restrictions. This has also led to some confusion on liquidity and the availability of these funds. And then when MISPA came into play a couple years ago, it really blurred the line between temporarily restricted and permanently restricted net assets. So the second objective is to really make the information about the amounts that are restricted more clear and more useful to readers. The readers should be able to better understand the types of restrictions, whether it's for purpose or time restricted. So the new standard moves net assets from the three classes, so unrestricted, temporarily restricted, and permanently restricted, into two classes, with donor restrictions and without donor restrictions. With donor restrictions includes both the temporarily restricted and perpetual. So perpetual is a new term that is in the new standard, and this is what we used to call permanently restricted. With donor restrictions is what used to be called unrestricted, and this includes board-designated funds. In terms of disclosures, organizations are required to disclose the detail of what is included in net assets. So, for example, how the funds are restricted and for what purpose. Disclosures have to include if there are time restrictions and what the timing is, so when the funds can be used. They also have to include purpose restrictions and for any designated amounts that are designated by a board, what the designated purpose is. Organizations are also required to disclose certain quantitative and qualitative information about board designations. We'll go into this in a little more detail in a few slides. Also, underwater endowments are now required to be included in net assets with donor restrictions. So this is a change from they were previously presented in unrestricted net assets. We'll also go into this in a little more detail in a few minutes. So here's an example for the presentation of net assets in the statement of financial positions. These are two different examples. The top is really the minimum requirement. So this just shows what is included in the two different classes of net assets. Then there would also need to be a footnote that discloses the additional detail related to these two different classes of net assets. The bottom example breaks out the detail on the actual face of the statement of financial position. So as you can see, the detail includes the two classes broken down to show any designated amounts and their purpose, any time restrictions and when they're expected to be used, any purpose restrictions, and then the perpetual amounts. Here's an example for the statement of activities presentation. So there are actually three options for how the statement of activities is presented. The first is a single column. So this is where you would show the activity by class. So you would start with net assets without donor restrictions. You would show all the activity and then come to a total at the end. Below that would show the activity for net assets with donor restrictions and then come to a total. And then at the very end would be the grand total for the change in net assets. The second option is the example that's shown on the slide here. So this is where there are multiple columns, so one for each class and then with a total column. And the third option is to present two statements. So the first statement would show revenues, expenses, and any other changes in net assets without donor restrictions. Then there would be a second statement showing changes in net assets for donor restricted activities. So as far as the new standard goes, as it relates to net assets, there are a lot of changes in terminology, but I don't think a lot of really significant changes in what is required to be presented, just a little bit more clarification to the disclosures for the users of the financial statements. Now we're going to pause and do our second polling question. Do you believe the users of financial statements will find the new net asset classification to be easier to understand, more difficult to understand, or no change? So So I'll give you a few moments here to respond. And just as a reminder, to get your CPE credit, we do need responses to our polling questions. Okay, give it a couple more seconds. Okay, great. So it looks like the majority of our audience really does feel that the changes add some clarity to the readers of the financial statements. So that's a good sign, I guess, since we are required to make these changes. Glad to know that seems like most people are pretty on board with them. Now I'll pass it back over to Tammy. She's going to talk a little bit more about the requirements for net assets.
Great. Thank you, Danielle. So one of the next areas for discussion has to do with board-designated net assets. And this is something that has existed for some time, and there has been some required disclosures related to this. With this standard here, you must have some policies or practices that are in place for board-designated net assets. Even if you do not have any designated net assets, so it's important to ensure that your board has a policy that is in place that is being followed throughout the year. The disclosures that are required have to do with both the nature and amount of the board-designated net assets. Usually we find this within the footnotes to the financial statements. However, it can also be on the face of the statements. We will usually see that within the statement of net position, within the net asset categories at the bottom there that shows what amount without donor restrictions, and then there would be a portion that was board designated without donor restrictions. We have included some of the glossary information as far as what the definitions of those board-designated net assets are. They are considered to be net assets without donor restrictions because it is related to an action of the board, and the board could change those designations at any point in time. So although there are restrictions, they are not donor restricted. And again, this is where that clarification I think is really helpful, moving from the unrestricted, temporarily restricted, and permanently restricted net assets to those without donor restrictions and those with donor restrictions. It really helps to clarify that those board restrictions are an internal designation without any kind of donor restriction. Those designations can be earmarked for future programs, investments, contingencies, etc. Oftentimes, you do have additional funds left over at the end of the year that the board wants to set aside for future uses. And so this helps ensure that the readers know that there are funds that have been set aside for future expenditures and what those are to be used for. Oftentimes, boards can designate those decisions to internal management, but they are still considered to be board-designated net assets, even though that delegation has been turned over to internal management. There have also been some changes with restrictions related to property, plant, and equipment. If property, plant, and equipment was being depreciated, was contributed to the not-for-profit organization with explicit donor-imposed restrictions on the length of time of the item's use, then net assets with donor restrictions should be reclassified as net assets without donor restrictions in the statement of activities as those restrictions expire. The amount classified may or may not be equal to the amount of the related depreciation. The amount to be reclassified shall really be based on the length of time indicated by the donor-imposed restrictions, if a restriction exists, while the amount of depreciation is based on the useful economic life of the asset. So for example, you may have a computer that was donated to you and is to be used by the not-for-profit for a period of 3 years, and therefore would be brought out of net assets with donor restrictions and released into net assets without donor restrictions over that 3-year period of time. However, you may find that the economic useful life of that computer is 5 years, and you would be depreciating it over that 5-year period. So that's an example where they may be different. They may end up being the same depending upon what those donor restrictions are. Absent any donor stipulations specifying how long such donated assets or assets constructed or acquired with cash restricted for such acquisition or construction must be used, then restrictions on those long-lived assets, if any, expire when the assets are placed in service. So this is a little bit different than what was done in the past, as there could be an option in the past where donor-imposed restrictions were released over the estimated life of the asset, and that removes that option. So if there are no restrictions over the useful life, or not the useful life, but the use of that asset, then those net assets should be released once it is placed in service. So again, purpose-restricted contributions of property, plant, or equipment that are without donor-imposed stipulations that specify how long the donated asset must be used, as well as contributions of cash that's restricted for the acquisition or construction of property, plant, or equipment, shall be reclassified when when the asset is acquired or constructed and placed in service. There may be circumstances in which a donor restriction may extend beyond the point at which the property, plant, or equipment is placed in service. So for example, a donor may specify that a donation which is restricted for the acquisition of property, plant, or equipment must continue to be used for a specified period of time. In those circumstances, the restriction would expire over the period of time that the asset is to be used. Underwater endowments is another area where there have been some changes, and I think a lot of organizations will find this to be very helpful. As you know, in the past, under the standards that have been in place, if there were losses on an investment in an endowment that brought the value of that endowment below the original corpus, then not-for-profit organizations were required to show those losses within unrestricted net assets. And we really saw real significant impacts on the unrestricted net assets for a lot of entities during the recession, when the investment market was showing significant losses. And we saw a lot of our clients with some negative unrestricted net assets because of that. With this new standard, because we have the net assets with donor restrictions and those without donor restrictions, any losses that result from those underwater endowments are shown within those with donor restrictions. So it does help separate your statements to show that those losses are related to your investments with donor restrictions. There are some required disclosures related to this. You do have to disclose your policy for spending from underwater endowments, whether or not you've taken any actions during the fiscal period related to those. And then for each period a statement of financial position is presented, you do need to include the fair value of any endowments that are underwater, the original gift amount that is to be maintained by the donor, so that original corpus of those underwater endowments, and then the difference between those two amounts, which would be the amount of the deficiency of those endowment funds. So this is just, again, providing readers of those financial statements, the value of those underwater endowment funds, and the amount of the loss related to those. On the next slide here, we just have an example for you of what that footnote may look like. And as you can see, there is a reference to SPMIFA, which is the State Prudent Management of Institutional Funds Act. As you know, each state does have their version of what you will also hear referred to as UPMIFA, which does require you to invest endowment funds in such a way that you try to maintain the level of allocations and distributions over those endowment funds. The disclosures also here shows what a board has done as far as the continued appropriation for certain programs that they deem prudent by the Board of Trustees. So additional just information here for you as an example that you can use in moving forward with this. And next, we will have Danielle will talk a bit about liquidity and availability.
Thanks, Tammy. First, I wanted to apologize. We have one mistake in one of our slides, so I'll take us back to the slide. It's our example for the statement of activities, and thank you for some of our attendees for pointing this out. So the first column is without donor restrictions. The second column should be with donor restrictions. So we had two columns that had the same title, so apologize about that. And we will have these slides available for everyone, and we'll make sure to make this correction before we push those slides out. So just wanted to bring that to your attention. Okay, so now we're going to move on to another set of required disclosures relating to liquidity and the availability of resources. So the new standard requires qualitative and quantitative information to be disclosed. So this information should provide users of the financials with an understanding of the organization's exposure to risks and specifically how it manages its liquidity risk, and also information about the ability to meet cash needs for expenditures within 1 year from the statement of financial position date. So the quantitative disclosures are required to include total financial assets available to meet cash needs within 1 year. So this can either be done on the face of the statement of financial position as a classified statement or in the footnotes. And we included here the definition. This is from the Master Glossary of what a financial asset is. So financial assets are generally consist of cash and cash equivalents, receivables, promises to give, operating investments, distributions from split interest or beneficial interest agreements, and then if there are endowments, the spending appropriations from the endowment. The next slide here is going to show an example. So this is actually pulled right from the statement. And this example takes the total financial assets at year end, and then it removes anything that's not available within 1 year from the financial statement date. So you can see the types of the financial assets that we kind of just talked through, and then pulling out some of those areas where they're not liquid resources to the organization. So in thinking about some of these changes, these new requirements, they might be some of the most significant in terms of how they can impact certain organizations. So for organizations that might have a more strained financial condition or limited available liquid resources, This will really, it will now be much more apparent to the readers of the financial statements. And for organizations that don't currently present a classified statement of financial position, these organizations will have to go through an exercise to spend time determining, what resources will fall within that category of available financial assets within 1 year. For these organizations, I would really suggest they start looking at this and just kind of seeing how this information is going to fall out, and really even thinking about who the users of their financial statements are. Thinking about, is there an opportunity to discuss this now with some of the users, such as your bank, or looking at, are there other financial assets that you could look to, adding into this, or available resources such as, looking to enter into a line of credit that could really strengthen some of the availability of funds in terms of liquidity. Another thing to consider, does the amount of the financial assets that are available to be spent within that 1 year period, does that point to any doubt about the entity's ability to continue as a going concern? That's another area that this might actually trigger a little bit more than anything in the past. And these are all things that just might need to be considered by organizations as they go through thinking about the transition to the new reporting standard. I'm going to pass it back to Tammy to talk about some of the requirements related to expense reporting.
Thank you, Danielle. There are some new requirements related to expense reporting, and that has to do with presenting expenses by function as well as natural classification. In the past, this was a requirement for voluntary health and welfare organizations, so you will see this in a lot of financial statements of not-for-profit organizations. However, this is something that will be a required disclosure or information for organizations when you do adopt this standard. The functional expenses can be included in the footnotes. Oftentimes you will see a footnote with that information in a separate statement. You will often see that as a statement of functional expenses that is in addition to the statement of activities, or you may see it within the statement of activities itself. The reporting of expenses by nature and function is useful in associating expenses with service efforts and accomplishments of not-for-profit organizations. The relationship between functional classification and natural classification for all expenses are to be presented in an analysis that disaggregates those functional expense classifications, such as program services, supporting services, and those supporting services. And so it's really giving additional information to users of those financial statements as far as what expenses are directly related to providing programs for the not-for-profit organization and what expenses are related to supporting services. Where your natural classification are expenses such as your salaries, rent, electricity, supplies, interest expense. Those are your natural classifications. So it's taking those expenses and moving them into a functional classification that shows how much of those salaries, how much of the rent is related to program services and how much is related to supporting services. When you are going through that, oftentimes you have to do an allocation of those costs. So you really want to spend some time analyzing those costs and coming up with a way that is a natural way of allocating those costs that really makes sense. And part of what the auditors will do in auditing those statement of functional expenses is looking at the assumptions that you're using to allocate those costs to ensure that they're reasonable in making those allocations. If you do have some of your natural classifications that, for example, your salaries, wages, fringe benefits that are included in something like a cost of goods sold on the statement of activities, then you would still include those within your functional expense analysis. So those would still need to be allocated within those functional expenses. So as I mentioned, many of these expenses will need to be allocated. So the program services, again, those are really expenses that relate directly to the major purpose for the organization or of the organization. Supporting services include things such as management and general activities, fundraising activities, as well as membership development activities. But oftentimes you do have costs that relate to both program services as well as supporting services. So an example would be your utility expenses. You have expenses for your heat, lighting, etc., that belong directly to program services, but also some of those supporting services. And oftentimes what we see for the methodology in allocating those expenses are square footage. So you may be looking at particular areas of the building that are used only for program services, where other portions of the building may be used for supporting services. And so again, it's really important to think about how you are allocating those costs between your program services and supporting services. Oftentimes payroll, you have individuals such as the CEO of the organization that may be spending some time directly related to programs, but also performing management and general activities. And so again, looking at how is that time being allocated. You probably will want to do some kind of a time study as far as tracking the time for a period of time, what that person is working on, and then allocating the time over the year based upon that time study. And that will be something that you would want to do every so often to ensure that that allocation is still reasonable. It may be actual direct time. Individuals who are working on various programs and supporting activities may track their time on a daily basis and directly allocate those costs based upon actual time. So again, it's very important to spend some time thinking about the methodology that you will use in order to allocate those expenses. The next slide here just shows some of those examples where you may have to allocate those expenses. I mentioned already CEO or executive director, CFO time. IT is another great example. We talked a bit about utilities. Depreciation is another area that you may have some assets that are directly related to programs and being used for the programs, and others that are being used for some of those support activities. The next slide here shows an example of a statement of functional expenses. This is an organization that has 3 different programs. And you can see here where the natural classifications that are along the left, the salaries, benefits, grants to other organizations, etc., are allocated or directly shown within each one of their programs. And then there's also the supporting activities, the management in general, the fundraising activities, and then the total supporting activities. And then you have the total expenses here. Those total expenses typically then are the same amount of the expenses on the statement of activities. So it's important to ensure that you do allocate all those expenses and capture all the expenses within the statement of functional expenses. Again, you can see here down towards the bottom, you have office and occupancy, depreciation. Oftentimes those expenses are allocated using some kind of a reasonable basis, such as square footage, time and effort on a job, etc. Okay, it is time for another polling question. Our polling question here are, what aspects of this new standard are you most concerned with in implementing this new standard? We wanted to get a sense for how everyone is feeling about it, if there are any areas where you think there may be some issues in implementing that. I'll give it a minute here for everybody to get their responses in. Okay. Well, very good. I'm glad to see that with the net asset classification, it looks like people are feeling pretty good about that. You know, I believe that it does simplify the face of the statement. Certainly, there's still a lot of disclosures related to those net asset classifications that are there. The liquidity and availability disclosures certainly will have an impact on a lot of organizations. And so certainly something that, as Danielle was talking about earlier, you want to spend some time thinking about that and how that will be implemented. The functional expense reporting is also an area it looks like people have some concerns about. The good news is there's a lot of information out there because there are a lot of organizations that have had to report this in the past. So there should be a lot of information for you to use and how some of those expenses have been allocated by other organizations. All right, and moving on, I will turn it over once again to Danielle to talk a bit about investments.
Thanks, Tammy. Okay, I'm going to cover just a couple more areas that were impacted by the new reporting standard. So the first one is how the investment return is presented. So this is one area where there was some variance in practice. The standard that's in existence right now actually requires gross presentation. However, there were some organizations that were including some net amounts. I think sometimes mainly because of the complexity in trying to pull out some of the expense, especially if an external investment advisor is used. So this change to the standard is really trying to get readers comparing apples to apples when they're looking at the financial statements of different organizations. So organizations are now required to show net presentation of investment return and investment expenses. So the external expenses should be netted. So for example, that would be the cost of an external investment advisor. Direct internal expenses should also be netted. So direct internal expenses are expenses that are specifically related to generating investment returns. So for example, if your organization has an employee and they're responsible for developing investment strategy and then monitoring that the strategy is being followed, his or her time for these activities would be considered a direct internal expense. Time spent on things like reporting or calculating unitization or other endowment-related aspects are not considered a direct expense since it doesn't impact the investment return. Also, organizations are no longer required to disclose the gross income and the expense in the footnotes. This is optional, but it is not required any longer. Okay, the last change to talk about relating to the new reporting standard relates to the statement of cash flows. So for organizations that use the direct method, they're no longer required to show the reconciliation to indirect. This is optional, but is not required any longer. And then as Tammy had mentioned toward the beginning of our webcast, the FASB is still working on phase 2, and there's a couple statement of cash flow topics that are included in that phase 2. So we're going to talk a little bit about that on our next slide. So that takes us through the new reporting standard. As a reminder, this update, it doesn't change any rules related to the accounting. So none of the policies in terms of how things are being accounted for needs to change. The changes really only are for how information is reported and disclosed in the financial statement. So just keep that in mind as you're thinking through how to implement some of these changes. There are a couple other projects and matters we wanted to bring to your attention. So the first one here, last Thursday, an exposure draft was issued for a technical correction to the reporting standard that we just covered. The comment period for this closes on November 11th. So the proposed change is to remove a phrase that was included in the requirement for the endowment reconciliation. So this is the table that shows the beginning balance in the endowment, any activity for the year, and then brings it to the ending balance. In the updated standard, there was a change made to some of the language, and this technical correction basically removes the change and reinstates the historical language. And the reason for the change was really because they found that the revised wording was not very clear. For revenue recognition, specifically as it relates to grants and contracts, so there have been two issues that have been raised. The first is characterizing grants and contracts as reciprocal transactions or non-reciprocal transactions. So as a reminder, contributions are scoped out of the new revenue standard. And the second issue is distinguishing between conditions and restrictions for non-reciprocal transactions. These issues have been raised by various AICPA expert panels, the FASB's NFP Advisory Committee, which is known as the NAC, and other stakeholders. So these issues have actually been added to the FASB board agenda, and they're considered, I guess, a formal project. So if you go onto the FASB's website, they have a section for the project, goes through the background, the status, and then the timing for this project. These issues were also discussed with the NAC at their most recent meeting, which was in the beginning of September. Currently, there's not been a timeline set for the release of any additional guidance relating to these issues, but this is something that is currently in process. As it relates to the not-for-profit reporting, the FASB is still working through phase 2, which really consists of areas that were originally introduced but did not end up in the accounting standard update that was issued in August. The FASB board has not begun to deliberate on phase 2. There's actually another FASB project on financial performance reporting, which relates to all entities, so it's not just for not-for-profits. And phase 2 has been postponed to await any further developments in this financial performance reporting project, since it covers some of the same topics. So you can see phase 2 covers operating measures, a couple more topics within the statement of cash flow, and then expense reporting specifically for healthcare entities. Currently, there's not really a timeline estimated for any updates to the standard for phase 2, so just wanted you to be aware of that. And Moss Adams is closely monitoring these different projects, especially the RevRec, since that is effective for some entities as early as 2018. So we'll continue to issue articles and webcasts and any other tools as information becomes available as the FASB and the AICPA put out any further guidance in these areas. And then one final note we wanted to bring to your attention, for uniform grant guidance, We just wanted you to be aware that COFAR has recently announced that they will be releasing a new set of FAQs. So they had a set that came out, I believe, in September of 2015, and this will be the second set related to the uniform guidance. They had communicated that these new FAQs would be out hopefully by the end of October. I checked this morning, I didn't see them, so I think they should be released at any time. And now we're going to move to our final polling question. So which of the following new standards do you believe will be the most challenging to implement? Okay. Well, it looks like it's almost a tie. So it looks like revenue, leasing, and then both are pretty close there. So there are some pretty significant changes coming up in the next 2 to 5 years between the new reporting standard, the RevRec standard, and the lease standard. So as I mentioned, we were closely tracking these areas. We have some resources already available. We have a really good kind of lease guide on our mossadams.com website. And then we'll continue to provide resources that can hopefully assist you with the transition. Also, the AICPA website has some really great resources as well, so I encourage you to kind of go there and check out what they have there to help with some of the transition. So thank you for joining us today. I'm going to turn it back over to Emily for some final reminders.
Great. Thank you, Danielle, and thank you, Tammy, for a great informative presentation this morning. We had a lot of questions come in, and I just wanted to let everyone know that we will be following up with you after the webcast via email to answer your questions. If you have more, please feel free to enter those in the Q&A box now. I'll be leaving the console open for a few minutes to get those last-minute questions in. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive that credit. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer in the lower right corner to download a PDF copy of your certificate now. And as I mentioned, I'll be leaving the webcast console open for a few more minutes to give you time to download your CPE certificate, and you can answer or ask any last-minute questions. A copy of your CPE certificate will be emailed within the next 2 weeks, should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you again for joining us, and we hope you'll join us again next time.